All right. Hello, everybody, and welcome back to another episode of the Wealth Building for Dummies podcast. My name is Kyle Demian. I'm joined here with Renji Matthew. And today we're going to be talking about actually a question that came in from one of our viewers. And it's one that we've actually gotten a few times, but people are just asking in general, where should I put my money? Where should I invest? What should I invest in? And Renji and I always come back to what we call the 5 principles of money. 5 principles are what we use to analyze any financial decision before we ever make it. And those 5 principles are safety, liquidity, rate of return, taxation, and fees. So Renji, let's break down the 5 pillars for our viewers, and let's start with the first one, safety. Can you tell us something about safety?
Yeah, so safety is basically how safe is your money, right? So we'll use examples for each of these. So let's say you put money in the bank. If you put money in your bank, you know it's safe, for the most part, at least. At least you're the only one that has access to it, right? So you want to look at wherever you put your money, whatever retirement account, whatever asset you put your money into, is your money safe? Of course, with wealth building, there are assets you get into that could cause some issues, down the line. But you want to overall look how safe is your money, and if it's going to go anywhere, or you're going to lose it all, if how safe is it? So when you compare it to the bank, your money's safe. When you compare that to like a 401k, you could lose all that if the market goes down, right? So that's where you want to look at safety, and that's why we talk about these secure retirement accounts. You have the safety, you don't ever lose money. So, Kyle, if you want to add something to that, do that. Otherwise, you want to go to the next one.
Yeah, no, that was perfect. The next one is liquidity. And think of liquidity as like accessibility. How quickly can you get access to your money should you need it, right? So, well, let's just keep with the examples 'cause I think this helps people like visualize how and why it works, right? But for example, in your bank account, your savings account, you can get access to the money today, right? Whereas if you have money in like a 401k, there can be some penalties and or taxes associated with that. But also, it could take a few days to transfer your money from your 401k to your bank account, so it's not that liquid. And also, for example, like real estate, right? If you have money inside of real estate, the only way you can ever get money out is maybe by taking, a line of credit or doing a sale on your house and having to sell it. And obviously, that could take an extended period of time. And there's not that there's necessarily a right or wrong answer, but like these are the things you need to think of when you're determining where you should put your money, right? If you were to tell us that in 30 days, you're planning on closing out a home and you're going to need access to $50,000, you're wanting to know where to put this $50,000, you should just keep that $50,000 in the bank because you're going to need it in 30 days from now, right? But if you have this $50,000 and you say, hey, this is for my retirement, but you're only 35 years old, you've got maybe, 30 years to retire, right? So you could put that into something like a 401k, an IRA, or in a brokerage account, right? For example. So it really just depends on your timeline and your goals. But that's how, once you identify where you're at and what you need the money for, that's how you utilize these 5 pillars to actually help you make educated and smart decisions with your money. So that's liquidity. Renji, how about rate of return for us?
Yeah, rate of return, same example. If you're using a bank account, you don't get much rate of return. I think average around the country is like 0.05. So unless you have hundreds of thousands or millions in your account, you're not going to see a big change, and not enough big enough change to get taxed on anyways, right? So, but when you look at 401ks and IRAs, you could get really good rate of return because the market could go up 20-30% in 1 year, and you could get a lot of return. And same thing with real estate and stuff. You can get great rate of return, especially through COVID. The market went up like crazy. I think on average, people's houses went up anywhere between 50 to 80 grand in value, right? So there's good rate of return. So yeah, so that's you want to look at, hey, how much of the money am I going to get back on my money that I invested? So that's what you want to look at in whatever you're investing in. What about you, Kyle? What's the next one?
So the next one's probably the most important, and most people tend to overlook it or not worry about it, and that is taxes. Taxes. How, actually, to plug our book club book that we're reading right now, right? Tax Free Wealth by Tom Wheelwright. Taxes are every single individual's largest and greatest expense. So if you ignore it, you're going to end up spending more over the course of your lifetime than otherwise if you were to do some tax planning, right? So taxes, how is your money going to be taxed as it's growing? There's three different buckets for your investments or the places that you can store your money. There are tax now accounts, which are taxed every single year on your growth. There's tax deferred accounts, which are not taxed now at all, but you're going to be taxed later or deferred. You're deferring it to the future whenever you take out that money in income. And then lastly, there's a tax free bucket or tax free accounts, which you purposely pay taxes on the money now. That way you get taxes over and done with, and your money continues to grow tax free for the rest of your life. So, how is your money going to be taxed? Analyze and look at that as part of your strategy as well. And then, Renji, how about the last one for us?
Well, the last one is fees. So going back to that same example of a bank, most banks you don't have a fee, right? Unless you're wiring money or different things like that. But there are bank accounts that have fees, but with that fee comes some kind of value that they're providing. So that's what you want to see. Yes, if I'm paying for something, how much value am I getting from that? So that's another way of looking at how much investment is this to rate of return, right? So with 401ks and IRAs and stuff like that, a lot of times people don't see the fees because they're taken out of your paychecks before the money goes into that. So unless you're actually opening up your statements and looking at reading through it, you might not see the fees and stuff like that. And then you can look at, every household has either Amazon Prime or Netflix or whatever. you know, for that amount you're paying, they're providing you with a service that's letting you watch shows and movies and stuff anytime you want from anywhere, right? So that's the value they're providing. So just like that, you want to look at when you're looking at investments, hey, if I'm paying a fee, what kind of value are they providing? So you want to analyze that into real estate or whatever, whatever it may be. So that's what you want to look at with the fees. Anything you want to add to that, Kyle?
Yeah, the only thing I would add is that the poor look at the cost of nearly everything, but the value of nearly nothing. While the rich and the wealthy look at the cost of nearly nothing, but the value of nearly everything. They're always looking at the value rather than just the cost. And that's where most of us stop, right? We always just look at the price tag and make our decision based on that. But the wealthy are always looking at things as far as like investments, right? And real estate's a perfect example. A piece of real estate may cost $250,000. But if it's going to bring in $1,000 a month of cash flow or $2,000 a month of cash flow, like that exceeds the cost of getting into that investment, right? So don't necessarily always just look at fees as, oh, if there's a higher fee or if there's high fees with whatever I'm doing, that may not be the best decision, but look at the value that that account or that financial decision is going to bring to you and your family. And with that, that wraps up the five pillars: safety, liquidity, rate of return, taxation, and fees. Renji, is there anything else you want to wrap us up with for today's show?
Only thing I want to add is we talk a lot about wealth building through passive income. So take those same five principles, look into whatever asset you're trying to buy. The reason we like to talk about real estate so much, out of all those pillars, when you look at taxes, real estate is one of the biggest tax discounts you can get. Out of all businesses out there, they have the biggest tax benefits. So if you compare a real estate investment and let's say you put 100,000 into stocks, right, and 100,000 into real estate, yeah, your return right up front, money wise, you might have better on stocks and you might not as much on the real estate side. But when you take all the tax benefits and credits and everything that you get from the tax codes, you have a lot more stuff you can write off on the real estate side. So again, when you're looking at all these principles and looking at whatever investment you're getting into, look at all the different ways that it benefits you. Taxation, like Kyle said, is probably the last thing that people look at, or one of the things that people overlook. But there's so many different ways that you can save on different things in any type of business. And something we will do a podcast in the future talking about taxes and stuff like that, but something that people overlook a lot. So, yeah, I think that's where I would, the only thing I wanted to add.
Awesome. And with that, we wanted to keep this episode short and short to the point. That way you guys can come back and always get value out of this, right? So if you like this, you found this insightful, make sure to like this post and share it with a friend. Share it with someone else that you think should learn these 5 principles. That way they start becoming better with their money. As always, make sure to comment your thoughts below and let us know what questions you guys have. Maybe we'll do a show on it in the future. And we'll see you guys on the next episode. Take care and have a great rest of your day.